This is Neil Warren, and today I'm giving some practical VAT tips as we prepare for leaving the EU on the 31st of December 2020. Now, just to recap a point I've made in my earlier sessions on Brexit, although we left the EU on the 31st of January, it was largely the status quo with a transitional deal. That deal ends on the 31st December. So from the 1st of January 2021, we are a third country as far as the EU is concerned. We're outside of the circle. So in this session, I'm going to cover 5 different topics that will change on the 1st of January. Now, in other sessions, I've given some examples of things that won't change. For example, business-to-business rule on services. But in this particular session, I'm only going to cover things that will change. In summary, Calloff stock, MOS returns, VAT paid in other EU countries, how we get a refund, the retail export scheme being abolished, and the end of triangulation, the simplification scheme involving 3 businesses in different countries selling goods. So some quite important topics, and I'll cover them in that order. Call-off stock arrangements. Now, just to summarise what a call-off stock arrangement is, goods arrive in an EU country from another member state, and at the time of arrival, there is a known customer for those goods, VAT registered. Often the goods are stored in the warehouse of that particular customer. That's not compulsory, but usually from a practical point of view, that's what happens. And the customer calls off the stock as he needs it, and that triggers an invoice from the UK seller, and the customer accounts for acquisition tax on their own VAT return. And the positive outcome of this simplification arrangement is that the supplier in the other EU country does not need to register a VAT in the second country because of the call-off situation. The end of the transitional deal, let's look at the movement of goods. The goods come into the other EU country, effective from outside the EU. VAT and import duty is payable by a GB business on arrival of the goods into the EU. Customs duty, VAT at the rate in that country. The GB business is then holding stock in that country, therefore needs a VAT number, therefore being able to claim input tax on the import VAT and charge output tax on the future sales to customer or customers in that country. And a point I've made many times over the years, when a business trades in another EU country and makes supplies in that country, it does not get a local VAT registration threshold. A UK business only gets the 85,000 we have in the UK. In other countries, when supplies are made, it's a 0 threshold. Now, many businesses in the UK will already have VAT numbers in other EU countries if their arrangement is for consignment stock rather than call-off stock. And consignment stock applies when the goods arrive in the country, they're stored in a warehouse or unit, and the customer is not known at the time of arrival. They could be sold to customer A, B, C, D, etc. VAT number, suppliers in that country, domestic VAT, claim input tax on expenses. So for businesses dealing with consignment stock situations, they've already got their VAT numbers hopefully in place in the other country. They still pay import VAT and duty on arrival, but they're set up with their local registration. Reverse the outcome. Many EU suppliers in the last 3 months have been getting UK VAT numbers for the stock they hold in Great Britain. I say Great Britain, we exclude Northern Ireland for goods. That's a separate arrangement under the Northern Ireland Protocol. So HMRC have been accepting VAT applications from EU businesses holding call-off stock in Great Britain in anticipation of the 1st of January. They've been accepting those registrations since the 1st of October, with the registrations going live on the 1st of January 2021. MOS returns, MOS standing for Mini One Stop Shop, and applies when a UK business or any EU business sells broadcasting, telecommunication or electronic services to B2C customers, so non-business customers, customers without a VAT number, Electronic services is probably the one that we're most familiar with, where we use it more commonly for downloads of software and similar supplies online. The place of supply for such services is where the customer is based. So if, for example, you download software to a customer in Denmark, B2C, it's local VAT 25% in Denmark, and that VAT is declared to HMRC on a MOS return at the moment, with all the different countries listed, the VAT payable in each particular country, and HMRC pass the tax on to the tax authorities in question where sales are being made. So at the moment, quite a simple process to deal with the VAT. And by doing a MOS return, you avoid the other scenario where you need to get a VAT number in each EU country where you're making these BTE supplies to non-business customers. Two things change on the 1st of January when we leave the EU. First of all, there's a threshold for EU suppliers of BTE services. They don't need to deal with this customer place of supply rule if annual calendar sales of BTE services, B2C, are less than €10,000, £8,818 in sterling. Once we leave the EU on the 1st of January, that threshold comes down to zero, so the place of supply being the customer's country effectively applies to all relevant sales. A UK business, now I say UK here rather than GB because we're talking services, so Northern Ireland Protocol is not relevant. The final MOS return will be submitted up to the end of 31st of December 2020 by a UK business, due and payable by the 20th of January. So from that date, the 1st of January, what should happen is the UK business will need to register for the non-union MOS scheme in an EU country of its own choice, and it makes sense to pick a English-speaking country like, for example, Ireland or Holland, possibly Malta, and then the single MOS return and tax payment in the future is made to that country. So it's a different scheme, but hopefully the same outcome apart from the threshold. Reclaiming VAT paid in other EU countries. Now, at the moment, we are part of the EU VAT refund scheme. So if you pay VAT in France, Belgium, Holland, etc. on expenses, EU VAT refund system, claim to HMRC, end of the calendar year, 9-month deadline to the 30th September, or claim quarterly. Final claim will be 31st of December again. You've got until the 31st of March to process the paperwork and submit the claim online for that final period. Once we leave the EU, we no longer are part of the EU refund system, and we have to make what are commonly known in the future as 13th directive claims. Now, that's a very, very different process, much more time consuming and much more wieldy. And basically, you have to submit individual claims to each EU tax authority where you have paid VAT in a particular period. It's not an online submission, it's a paper return, and the deadline is usually the 30th of June to claim VAT incurred in the previous calendar year. You can claim quarterly. There's monetary thresholds involved in how much you can claim quarterly. It's got to be a certain figure. The invoices are sent with the claim through the post, and unfortunately there's a language issue with most countries. They need to be submitted in the language of their own country, which again creates an extra hurdle that's not there at the moment. Now, I tested the system, just to get this clear in my mind, by thinking about a claim to the Netherlands. I chose that delivery because they speak English in Holland, so there's English information on their website. So how is a claim to be made? Well, there's a good website link on the EU Europa website, which I've given to you in the notes, which gives information on the claim procedure for each EU country. And it's very, very clear and well written. It highlights what expenses can and cannot be claimed, where forms can be downloaded, and where you then send the claims form in the post. In the case of the Netherlands, there's an input tax block in their domestic legislation on business entertainment, also food and drink purchased in hotels, cafes and restaurants, but they do accept claims in Dutch, English or German, which is good news. Overall, this is going to probably come down to a cost versus benefit analysis. Is it worthwhile submitting a claim for VAT to, say, Bulgarian tax authorities for perhaps a small amount of money that has to be submitted in Bulgarian? I checked that actually on the website. They do require it in Bulgarian, as do Poland. And again, once you've done the paperwork, you've sent it off to the tax authority and give yourself a pat on the back, will the tax authority pay that VAT and process the claim efficiently so you get your money? There's been some issues with that in the past. It's fair to say that the countries treat these 13th directive claims in some cases as a low priority. Retail export scheme, fairly simple comment here. It's being abolished on the 31st December. For those that don't know how it works, little example there. A tourist from Saudi Arabia visits a jewellery shop in London and buys an expensive watch for £36,000. Easy calculation, 30,000 plus VAT. The customer pays the VAT to the retailer when the goods are purchased, but takes away an export claim form within the retail export scheme. The goods leave the EU. The export document is stamped by the customs authorities. The customer gives the form back to the retailer to get a VAT refund, £6,000 in this particular case. Scheme to be abolished on the 31st December 2020. There have been some industry protests. Will there be a U-turn by the government? That's a case of watching the media to see if that might happen. Probably not, because one thing HMRC are trying to do is have the same rules for EU and non-EU arrangements. So if there's a refund scheme for non-EU suppliers, as is currently the case, it would probably mean extending it to EU customers, which would be expensive in terms of tax loss by the Treasury. Triangulation, my final topic of the 5, the pièce de résistance, because this is quite an important one, more important probably to your clients than the retail export scheme. Easy example, what we're talking about here: Polish manufacturer, GB intermediary, final customer in Germany. 3 different countries, all VAT registered, A, B and C. And from a commercial practical point of view, the goods don't go from Poland to UK out to Germany. They go straight from Poland to Germany. So A sells to B, B sells to C, shipment from A to C. And at the moment, the good news for B, and UK businesses are often B in these types of deal, there's no need for the UK intermediary to get a German or even a Polish VAT number. It's all sorted out by this triangulation process, which simplifies the arrangement. A invoices B, 0 rated, B invoices C, 0 rated, and C in Germany accounts for acquisition tax to deal with the VAT on their own VAT return and claim input tax of the same amount, subject to input tax rules on business, non-business, etc. Once we leave the EU on the 31st December, the triangle is broken because we're no longer in the EU. Looking now at the basic VAT rules, ownership of goods for the UK intermediary, either Poland or Germany, likely to be Germany, therefore the need for a German VAT registration to comply with the EU rules for trading in goods. So some important issues to think about. If your clients only act, for example, in services, in dealing services, they don't need to worry about triangulation, that's goods only. Calloff stock is goods only. And if they're not a retailer, they don't need to worry about the retail export scheme. So some of these issues will only be client specific rather than of general interest. And that concludes this session.